In our global economy, it feels like everything is connected. But what's the invisible force that can link something like a health crisis on one side of the planet to the value of your retirement fund? Well, today we're diving into exactly that, the powerful and often unseen ripple effect of risk.
So think back with me for a second. Over the last few years, we've seen it all, right? A global health crisis, a seriously volatile stock market, and these massive government stimulus packages. On the surface, they seem like totally separate, huge events. But what if I told you they're not separate at all? In fact, they are deeply, fundamentally connected.
The thing that ties them all together, it's risk. Risk is that invisible thread that can turn one single event into the next and the next, creating this incredible chain reaction that, believe me, impacts every single one of us. So, let's unravel how it all works.
Okay, but to really get how risk connects everything, we first need to think like a risk manager. Now, the word risk gets thrown around a lot, but for the pros who manage it day in and day out, it has a very, very precise meaning.
So, here it is, the big definition. At its absolute core, risk is simply the chance that something turns out, well, differently than you planned. It's not always about something bad happening. It could be good or bad. It's just a deviation, a swerve from the path you expected to be on. And this really gets to the heart of what a risk manager actually does. I mean, you can kind of think of them as professional fortune tellers, but instead of a crystal ball, they're using data and heavy-duty analysis. Their whole job is to figure out the odds of that deviation happening and then, find ways to steer things back on course. Now, you can't just lump all risk into one giant pile. It would be impossible to manage. So professionals break it down into 3 core disciplines. And understanding these categories, that's the first step to seeing the much bigger picture.
All right, let's break this down. First up, you've got market risk. This is the one you probably hear about the most on the news. It's the risk that comes from asset prices swinging around, like the stock market going on a wild ride. Next is credit risk. This one's pretty simple. It's the risk that someone who owes you money just won't pay you back. And finally, there's operational risk, which is this huge category that covers almost everything else. Things going wrong with people, processes, systems, or even big external events, like a supply chain getting totally disrupted.
And here's a really key way to think about operational risk. You can almost see it as the big catch-all bucket. Once you've accounted for all the financial risks from markets and credit, pretty much everything else that's left over, that residual risk, gets filed under operational. It is a massive, and as we'll see, a critically important category.
So we've got our 3 buckets: market, credit, and operational. And for decades, big companies basically treated them as totally separate problems. You'd have different teams and different departments who rarely even spoke to each other. But reality is messy, right? And the modern way of thinking recognizes that you have to connect the dots.
This brings us to a really crucial idea called enterprise risk. Now, this isn't another type of risk. It's a whole new way of thinking. It's about stepping back and looking at all the risks, market, credit, operational, as one big, interconnected system. It's about understanding how they all influence each other and the company's ultimate goals. So the really important thing to get here is this huge shift in thinking. We are moving away from seeing risks as these isolated little fires that you can put out one by one. The truth is, a problem in one area, say an operational one, can so easily spill over and become a huge market or credit problem. And that's exactly why this holistic view isn't just a nice idea. It's absolutely essential.
Okay, so how does all this theory actually play out in the real world? Well, let's look at a case study that every single one of us lived through. Honestly, there is no better or more dramatic example of interconnected risk than the COVID-19 pandemic.
Let's just walk through that chain reaction, step by step. It all kicked off as a health and safety event, a textbook operational risk. This started disrupting people and processes, first in one place and then globally. That fear quickly snowballed into a massive market risk, as everyone started worrying about global growth, sending stock markets into a nosedive. Then you saw the response. Governments and central banks stepping in with staggering amounts of stimulus to stop the financial bleeding. And that action? It was a direct attempt to stop the final, most dangerous domino from falling: widespread credit risk.
And this is such a fascinating comparison. If you think back to the 2008 financial crisis, credit risk was the absolute heart of the meltdown, the fear that huge banks couldn't pay each other back. With COVID-19, that kind of widespread counterparty crisis was, well, it was mostly avoided. And that was almost entirely because of how fast and how big that government stimulus was. Now, it didn't make credit risk vanish. Banks still had to brace for future defaults, but it did stop a full-blown financial contagion.
So, after seeing that powerful real-world example, what's the big takeaway here? What does this story of interconnected risk really truly mean for all of us?
If you remember one thing, let it be this. Risk isn't a series of separate problems you can deal with one by one. It's a web. You pull on a single thread over here, and the entire structure vibrates. A health crisis can become a financial crisis in what feels like the blink of an eye.
So, when you boil it all down, what we've seen is that a single external event can set off a powerful cascade, proving that those different disciplines of risk are completely linked. This is why that holistic, enterprise-level view isn't just some corporate buzzword. It's the only way to effectively manage risk in our crazy, complex world. The pandemic wasn't an anomaly. It was basically a masterclass in how this whole web operates.
And that leaves us with a pretty critical question to think about. Now that we understand how these ripples can spread, how one type of risk can bleed into another, what's the next great ripple effect that we're just not seeing yet? Where's that small, seemingly isolated event that's about to trigger a chain reaction that none of us are prepared for?